Hello everyone, we are Must Profit. Welcome to today's comprehensive institutional market outlook. Today, we are diving deep into the technical landscape of four major assets that are currently showing high probability setups. As a research analyst with 15 years of experience in these markets, I've seen how price action behaves when institutional order flow shifts, and today's session is no exception. The global markets are currently navigating a complex environment. With the recent high-impact data releases, including the non-farm payrolls, we are seeing significant volatility across metals, energy, and indices. In this session, we won't just look at candles, we will map out liquidity pools, identify untapped supply and demand zones, and look for the specific market structure shifts that indicate where the big players are positioning themselves. Our goal is to move away from retail traps and align ourselves with institutional intent. Let's head to the charts. We begin our analysis with silver, or XAGUSD, on the H1 timeframe. For the past several sessions, the narrative for silver was dominated by a bearish structure. We saw a consistent sequence of lower lows and lower highs, which kept the retail sentiment firmly negative. However, we recently witnessed a very powerful recovery that led to a decisive market structure shift, or MSS. This shift effectively invalidated the bearish trend and transitioned our short-term outlook into a bullish phase. As of right now, price has faced a sharp rejection from a key supply zone. This is exactly what we look for, a move into a premium area followed by a reaction. We are currently in a pullback phase. From an institutional perspective, this isn't a sign of weakness but rather a healthy retracement to seek liquidity at lower levels. Let's talk about the supply zones first. Our near-term supply sits between 75.50 and 76.50. This zone acted as a ceiling, causing the current rejection. If the bulls can gather enough momentum to break through this area, the path clears for a move toward the major higher supply scenario, which ranges from 79.50 to 82.00. This is an institutional distribution area, and we expect heavy selling pressure there. On the downside, we have our demand zones, which represent the discount areas. The primary demand to watch is 69.50 to 70.00. This is our immediate decision point. If price dips into this zone, we expect to see signs of reaccumulation. Below that, 66.00 to 67.00 serves as a strong structural base, while the extreme demand zone remains deep at 61.00 to 62.00. Our directional bias is as follows. In the bullish continuation scenario, price must hold above 69.50. If it does, the next logical move is towards 74.50 and 76.00. However, in the bearish scenario, a break below 69.50 would indicate that the bullish structure has failed, potentially leading to an expansion towards 67.00 or 62.00. Always remember, institutions look for liquidity sweeps at the highs before pulling price back to demand. Watch the 69.50 level very closely. It is the pivot for the next major move. Next, let's shift our attention to the energy sector with WTI Crude Oil. What we are seeing here is one of the cleanest and most aggressive trends in the current market environment. Crude oil has completed a textbook transition into a strong bullish structure, characterized by higher highs and higher lows. We have observed multiple break of structure events on the H1 timeframe, confirming that the upside momentum is being driven by sustained institutional buying rather than simple retail speculation. This is an impulsive expansion. In such a market, price rarely consolidates for long. Instead, it moves rapidly from one liquidity pool to the next. Currently, our major overhead target is the supply zone between 117.50 and 120.00. This is a higher timeframe zone that hasn't been tapped in a significant amount of time. It acts as a massive magnet for price, but it's also a zone where we expect to see distribution and profit-taking from the big players. Since price is currently in a premium zone near recent highs, it is not an ideal place for fresh positioning. We must wait for price to return to our institutional demand zones. The primary demand sits between 98.00 and 100.00. This area is the foundation of the current bullish leg. If we see a deeper correction, the secondary demand zone at 92.00 to 94.00 and the extreme demand at 87.00 to 89.00 are our major points of interest. In our bullish continuation scenario, as long as WTI remains above the 98.00 to 100.00 range, we remain focused on the upside. Our projected scenarios include 115.00, followed by the 117.50 supply, and finally the 120.00 institutional target. Conversely, in a bearish shift scenario, a break below 98.00 would signal that the momentum has shifted, likely triggering a deeper retracement toward 94.00 or 87.00. For the smart money, the current high prices represent a retail trap zone. They have already entered at lower levels and are now likely waiting to see if they can push price into that 120.00 scenario to liquidate their positions. Be patient and wait for the pullback to demand. Now let's move to the European markets and analyze the GER40 or DAX 40. This index has had a phenomenal bullish run, but our H1 and H4 analysis suggests that the tide might be turning, at least in the short term. We are currently observing a classic shift in market structure near the 23,400 level. This MSS is a warning sign that the demand that fueled the recent rally is starting to dry up. When we map out the liquidity for the GER40, we see a very clear sell-side liquidity pool sitting just below the 23,100 level. These are essentially the stop losses of retail buyers who entered late in the trend. Currently, price is reacting from a supply zone around 23,350. My technical observation is that the market is in a search for an equilibrium point, a price where institutions feel comfortable re-engaging. We have not yet seen a clear break of structure to the upside, which keeps our immediate bias neutral to slightly bearish. Let's look at the scenarios we are tracking. In scenario A, if the price remains capped below 23,200, we expect to move toward the primary demand zone at 22,950. This move would likely sweep the liquidity below 23,100 first. In scenario B, if we see a strong H4 candle close above 23,500, it would completely invalidate the bearish sentiment and suggest that the previous high is the next scenario to be tested. The key for GER40 right now is volume flow. If we see high volume selling at the 23,350 supply, it confirms that institutions are distributing. If we see a low volume drift, it might just be a minor pause before another leg up. My advice is to stay neutral until one of these two scenarios is confirmed. The 23,400 level is the line in the sand for the bears, while 23,100 is the critical support for the bulls. Finally, let's analyze the king of metals, gold. Gold has been the center of attention lately, with massive price swings driven by economic data and safe haven demand. Currently, we see XAUUSD hovering in the 4,670 region. While the H4 timeframe shows a series of higher lows, a structurally bullish sign, we are approaching a major institutional supply zone that could trigger a significant reaction. One of the most important things on the gold chart right now is a significant fair value gap, or FVG, left behind near the 4,620 level. In institutional trading, price action tends to be efficient, meaning it often returns to fill these gaps or imbalances before making its next major move. On the upside, we see a heavy concentration of buy-side liquidity, around 4,750. This leads me to believe that the big players might push the price slightly higher to trap early sellers and grab those buy stops before initiating a correction. Let's look at the execution scenarios for gold. In scenario 1, if gold fails to decisively break the 4,700 psychological barrier, we anticipate a move back down into the 4,600 to 4,580 support cluster. This would efficiently fill the FVG and test the strength of the buyers. In scenario 2, if we get a high momentum breakout above 4,720, it opens the path for a scenario toward 4,780 or even 4,800. Because gold is so volatile, I always look for a market structure shift on the lower timeframes like the M15 or M5 to confirm that the higher timeframe scenario is playing out. Additionally, keep a close eye on the DXY. There is a strong inverse correlation here, and if the dollar shows strength, gold will likely head toward our downside scenario to fill that 4,620 gap. In summary, for gold, patience is your best friend. The current price is in no man's land. Wait for price to reach the 4,700 supply or the 4,620 demand before looking for a high probability entry. To wrap up today's institutional study, silver is in a healthy pullback phase, WTI crude oil is in a dominant bullish expansion, GER40 is at a critical neutral to bearish tipping point, and gold is searching for liquidity between major supply and demand zones. The common thread across all these assets is the need for confirmation. As retail traders rush in based on emotion, we wait for the footprint of the institutions. Wait for price to reach your identified zones, look for a structure shift, and then align your trade with the dominant flow. This technical study is based on 15 years of market experience and is provided for educational and research purposes only. It is not financial advice. Markets are inherently risky, so please stay disciplined with your risk management and follow your own strategy parameters. Thank you for joining me in this deep dive. We are Must Profit, wishing you a successful and disciplined trading session. Happy studying.